Ken Griffin, David Tepper, and Paul Tudor Jones all have in common, aside from the fact that they're billionaires? They run hedge funds. So what is a hedge fund really? When you think about how most money managers work, their job is to either replicate the performance of the market, maybe the stock market or the bond market, based off of some index or benchmark, or try to beat the performance of that benchmark. The key thing here is their performance is measured relative to that benchmark. Hedge funds evolved as a way to invest your money and generate absolute returns that are not relative to anything else. So making or losing money regardless of whether the overall market goes up or down. The word hedge in and of itself means to offset. So when you think about an institutional investor allocating some portion of their portfolio to a hedge fund, it theoretically shouldn't just replicate the other parts that are invested in just stocks or just bonds, but rather serves to offset those returns. And so you'll hear about all these different strategies like equity, long, short, macro, relative value, distressed debt, activist investor. All a hedge fund really boils down to is it's a way to try and grow your money faster than the rate of inflation that is unrelated to the overall direction of the equity and bond markets. Hedge funds manage mostly institutional investors' money, think pension funds, insurance companies, endowments, although oftentimes senior managers will have some of their own capital invested as well. They typically charge 2 and 20, but how that pay is divvied up internally amongst portfolio managers and analysts and execution teams varies considerably from fund to fund. And unlike private equity firms, because most hedge funds tend to be invested in more liquid and publicly traded assets, they have to provide regular mark-to-market statements to their investors, meaning their performance is measured in real time on a monthly and annual basis. So at a hedge fund, when a portfolio manager has a great year, they're going to see a huge payday right away. But if a trade goes massively against them, it could trigger investor redemptions, and you might even hear about funds blowing up. It's one of the most high-risk, high-reward, competitive, exciting, and potentially lucrative sectors of the financial services industry to be in. Hedge funds typically recruit from investment banks. For equity long short analysts, they'll be recruiting out of corporate advisory and M&A. For macro, credit, and relative value hedge funds, they're typically recruiting from sales and trading roles. And oftentimes, you'll see traders go back and forth between the sell side and the buy side over the course of their long careers.